Hello, my name is Kurt Worley. I am the quantitative analyst, the so-called quant, at fxbootcamp.com. Today is Thursday, November 12th, 2009. This is your New York session video technical briefing. It's a video review of some of the things we covered in the live class today at fxbootcamp.com during the New York session. Before I get started, I'd like to request your feedback on this video. Whether you're watching this video on FX Bootcamp's YouTube page or on our Facebook page, or possibly from a link on FX Bootcamp's Twitter page, or even on our blog, please leave a comment when you are done watching, even if you just say hi or thanks. I would really appreciate that. Now I'd like to clarify that the purpose of FX Bootcamp is education. This is not an alert service. The currency coaches do not make trade recommendations, but we do provide real-time technical and fundamental analysis to help you put together your trade plans throughout the day. We assume that our newer Bootcamp members are trading on a demo account, so that regardless of whether or not any particular trade plan is successful, they will certainly have an opportunity to learn and eventually trade their own live accounts for years to come, both profitably and independently. What you now see is a view showing two charts for the Euro-USD currency pair as they looked at 10 a.m. New York time on GFT's Dealbook 360 trading platform using FX Bootcamp's custom layout. On the left is a 15-minute chart, and on the right is an hourly chart with daily pivot points. At this point in time, we were looking at a double bottom having just formed on the 15-minute chart at the daily S2 pivot point. There's your double bottom, and that is a common bottom on a downtrending day of the S2. Now, I told the live class during my London Lunch session after the first touch of S2 that it might be as low as the euro gets today. But even as the euro paused at the double bottom, I was thinking about the price action over the past 24 hours on this euro, which got us to this point. I'm going to use two charts to explain what I mean by that, what I was pondering at the time. First, a daily chart. I've got this Euro-USD daily chart zoomed out to show the price actions since early June through yesterday. The predominant theme since the early June has been dollar weakness, which means up on this pair. Dollar weakness means up. Last month, the euro struggled over the course of 4 trading days to break the 50-50 area. I'm talking about this price action right there. 50-50 area denoted by the horizontal black line at the top of this chart. Now, the euro failed to break it, then dropped for a few days, then back up for a few days. By the way, that was a bounce to the daily 55 EMA, which I do not show on this chart. Now, notice what happened yesterday. The euro failed again to break above the 1.50-50 area, and as a result, it looks like a double top is formed on this daily chart. Now, the double top is a common uptrend reversal pattern. Now, some might think that calling for a reversal of this multi-month trend of dollar weakness is a bit premature, and maybe it is, but the idea of a drop from a double top on a daily chart on a day like today without any major U.S. news certainly isn't crazy. If we look closer at the price action on a 15-minute chart without indicators since the double top, we find that maybe we're not crazy after all. From the double top up in here on the upper left hand part of the chart, the euro dropped during yesterday's New York session, followed by what you might call a New York afternoon fade, and through here, and then eventually the euro extends down during today's London session. My point is this: if I'm going to trade during the this New York session, I'd prefer to go with the flow. That flow has been down, has been the market buying dollars since the euro double top yesterday. And the most recent price action suggests that bears are stepping in and selling this pair on every rally. Look at the candles since the retest of the 1.4960 area. That is 5 wicks worth of lower highs. That is some serious evidence of traders looking to sell this pair on rallies. Then there's no doubt in my mind that we've now got a trend line running through there. So we've got a drop from yesterday's double top and a recent series of lower highs, all supporting the case for shorting this pair. Let's return to our original 15-minute chart with indicators to look for other clues to help us build a trade plan. Now, like pretty much every previous day this week, there is no major news on today's calendar. We did see a slightly better than expected weekly U.S. jobless claims report released 90 minutes prior to this point. The slightly positive report does suggest, if anything, increasing risk appetite, which means dollar weakness, and again, that means up on the Euro-USD. However, the brief rally on this pair during the 15 minutes after the release on this green 15-minute candle. That rally never did manage to break above the 1.4940 area. In fact, this pair staged multiple attempts over some 45 minutes of time to break 4940. That's in through here. Multiple attempts to break 4940, but could not do it. Now, boot campers and other longtime viewers of our video reviews might say, well, that's just a 21 EMA. That's the downward sloping red line of this chart. That's just the 21 EMA acting as dynamic resistance. In simpler terms, the 21 EMA is holding, is in control. I agree, no argument there. But as the euro dropped from that level to form a double bottom at the daily S2 pivot point, I got to thinking, is there more at 4940 than meets the eye? Well, I do see these prior swing lows. Those are pretty close to 4940, and they suggest that during the London session, the 4940 area was a source of support, whereas an hour ago, it was a source of resistance. We refer to that as roll reversal. Okay, that makes sense. Then I thought, why don't I look back in time a bit to see if 4940 was important prior to today? If it was, then I'll have even more trust in that level as a solid source of resistance. Check this out. The 4940 area was resistance for roughly 2 hours during Monday's Asian session. The very next day, about an hour before London close, it was support. So 1.4940 has been an important area during the first half of this week, and going back to our 15-minute chart with indicators. It was, as I just mentioned, it was important during today's London session, and just an hour ago it was important again, this time as resistance. Better yet, we've also got the 21 EMA working for us, as well as the black trend line I discussed earlier. Yes, I know that the most recent 15-minute candle is greener and bigger than you'd probably like to see after a double bottom at the daily S2, but if you're bearish on this pair, you're looking to short it at a level of resistance, and multiple clues do suggest that is exactly what you have at 4940. Now, if you're aggressive, you entered your short trade at the touch of the 15-minute 21 EMA or at the trend line. I showed the trend line at the top of this 1-minute chart. If you're more conservative, you wait for the cross of the 5 EMA below the 8 SMA on this 1-minute chart. Here's the 5-8 cross. In that case, your entry is at about 1.4930. Right in here. As you've heard me say many times before, your standard protocol could be to initially position your stop loss 50 pips away from your entry, in this case at 1.4980 for catastrophic protection purposes. As for your exit strategy, I'd say close the trade for a very small loss if price breaks a few pips above this recent swing high, which you can just make out above the trend line. Recent swing high right there at about 1.4943. Before I continue, I should note that for all the reasons I've already described, any test over the past hour or so of the 1.4940 area on these recent candles, any test of that area was a valid opportunity to short this currency pair. I wanted to draw attention to the entry at this particular time after the bounce of the double bottom, because it did require some serious conviction to take it in the face of a healthy green candle after the double bottom. Whether it was conviction to take that entry or simply patience to stay in the trade from an earlier entry, it did pay off. The dollar surged across the board and the euro broke below S2. 1 hour later, the euro strikes our target, a fantastic target, I might add. I say fantastic because there were several things pointing to the 48.60 area as a level at which to close this trade. The daily S3 pivot point, which you see shown at the bottom of this chart, the horizontal maroon line, was at 48.57. The daily 21 EMA was at 48.61, as I recall at the time, just above again the daily S3. And look at the daily chart shows multiple clues that the 48.60 area has been important in recent weeks. Notice the highs here from October 29th and 30th, very close to that level, but very close to our target level. And Monday's low, also near the same level. So if you took the conservative entry at 49.30 and then closed the trade at 48.60, you earned roughly 65 pips after spread. Back on the 15-minute chart, 1 hour later, was London closed, represented by the vertical red line, by which time, by the way, there was no doubt that the 4860 area caught the attention of more than a few traders. Again, my name is Kurt Worley, and this has been your New York session video briefing from fxbootcamp.com for Thursday,